So we're going to talk about the Polar Capital Global Financials Trust. And one of the main reasons for that is you'll have noticed that there's been an election in the States, and that's been quite a game changer for the level of interest in our fund and in our sector. So I thought now would be quite a good time to talk you guys through why it's an interesting thing to consider investing in. So here's an overview of the team. So we're 5 people that do nothing but invest in financial services businesses globally. We've got a sort of collective investment experience of about 100 years. So that's important in this sector because it's a complicated sector, it's a cyclical sector, so it's helpful to have been around for various cycles. And we do nothing but this sector, so we don't have any other responsibilities within Polar. It's a multi-boutique style approach, investment-led, as we were just discussing. So yeah, so that's the team. Here are the 3 products that we run, and the main one that we want to talk about today is the Financials Trust in the middle. So that's been around for over 10 years. It's just shy of 600 million in assets. It's the only investment trust that focuses on global financials. So we're really pleased with it as a very differentiated sort of proposition relative to other things in the investment trust world. This is the track record of the trust since the last tender, which was in 2020. So you can see that the trust has returned just north of 18% annualized return over that time period. That's ahead of the financials benchmark. It's also ahead of the Lipper peer group. And it's also ahead of global equity indices and the FTSE All-Share. So it's a sort of a pleasing return profile. We're very happy with that. Our shareholders are very happy with that. This shows you the performance over discrete years, which I'll skip on from. So let's take a step back and talk about when we talk financials, it means different things to different people. So perhaps the most important point to bear in mind is that it's the second biggest sector in the global equity market. So you hear a lot about technology, you hear a lot about healthcare, and those are very large sectors, but financials is a huge sector. And generally, when you think about the sort of clients that we speak to, people are generally underweight that sector in terms of their positioning. So that exposes them to a great amount of sort of benchmark related risk. When we talk to people, people tend to focus on banks. Banks are about 40% of the benchmark, so they're a very important part of what we do. But there are a whole variety of other sectors that operate within our universe. So we've got about a quarter of our fund in insurance companies, a quarter of the fund in diversified financials, which includes exchanges and data companies, which we'll talk about. And about 10% of the trust is in payments companies as well. So there's a very diverse opportunity set for us to pick from. And what we're doing here is giving you a sense of some of those subsectors and a sense of how differently they tend to operate, and which is why, as active stock pickers, it matters that you get your timing right when to consider which subsector. So if I sort of highlight a couple of them, so P&C insurance, that's general insurance to you and I. That sector is a sector that we like. For that reason, it's green. It tends to be more sort of defensive, slightly value oriented. It's something that we've had a big holding in our trust for a long time, and that's done very well for us. But that's not the only sort of company that we invest in. At the opposite end, so more towards cyclical growth, we've got alternative asset managers, which we'll talk about in a bit more detail later on. So that's an area of the market that we like, but it's very different. It tends to have structural growth characteristics. It tends to be more cyclical in nature. And then very topical, as we said at the beginning, in terms of the US election, we really like US banks at the moment. They tend to be quite cyclical too, but are more value oriented. So I hope you take away from this that actually within this large category of financials, there are a large number of different moving subsectors. And our job is really to just find what we think are the most interesting opportunities at a given point in time. This is how the allocation within the portfolio has evolved over the last 10 years or so. You can see the point is this trust has to be actively managed because the financial sector moves around quite a lot, can be quite volatile. So way back here, banks were north of 70% of the trust. Now they're more like 40, and we've got a lot more invested in diversified financials and insurance companies and payments as well. So it is important that within this space, that the stock selection is done on a sort of active basis rather than a passive one. So here are some examples of really fantastic businesses that we own in each of the main subsectors that we just talked about. So there'll be brands that you recognize. Many of them are leaders in their respective industries. So you'll have all have heard of JP Morgan, the biggest bank in the world, has compounded returns for a very long period of time. Within insurance, Arch Capital is something quite different. It's a Bermuda-based specialty insurance company that's delivered fantastic returns too. Within diversified financials, Ares is a private credit company that's really growing very, very fast. And then payments companies like Visa and MasterCard that you'll have heard of. So the point here is we're able to find, if you do the work and you understand the subsectors well enough, you're able to find some really great businesses in very different subsectors so you can offer a diversified and relatively balanced portfolio. And here's the evidence of what that looks like. So here are some of the companies that we just talked about, showing you the long-term value creation over 20 years of each of those companies. So in the case of the banks and the insurance companies, it's book value per share growth or earnings per share growth for some of the less balance sheet sensitive businesses. So these are not sort of characteristics that I think people normally associate with financial services businesses. So, but a lot of these have been in our portfolio for a very, very long period of time, and they form a really nice sort of bedrock for which to drive that 18% return that we were talking about earlier on. So why, taking a step back, why you might want to think about financials and what's the alternative opportunity set? I really like this chart. So what this does is it breaks down the global equity market into the various subsegments. So you've got the sectors here, and then the regions here. And the higher that each of the column is, the more of the global equity market is captured within that space. So the point of this slide is to highlight the extent to which US, so North American IT, dominates global equities, right? I mean, we all know that. If you've read a newspaper, you've heard that global equities are concentrated, but you probably don't appreciate the extent to which that's the case. So whether you own a global equity fund or a US equity fund, there's a very good chance that you've got quite a lot of exposure to that in some form or other. And the point that we're trying to make is not that we have anything against US IT, because those companies have done very well for shareholders. But our point is, given how concentrated global equities are, it's probably time to think about diversifying. And if you're going to think about diversifying, our proposition is that financials is an excellent way to do that. What this chart is showing you is the long-term swings between value and growth outperformance in the US. And the main point is that the period since the financial crisis has been actually very unusual by anything like historic standards. So this is the best part of a century of data. And you can see over here, you know, normal cycles when value was doing well or it was doing badly. And that was a sort of a normal period. Given that most of the people who operate in the markets, or many people who operate in the markets, have done so more recently, might lead you to think that, well, the investment framework should always be negative or extremely low interest rates. And in that sort of environment, growth stocks tend to do better. But actually, by any sort of longer term horizon, that's actually the unusual period. And our contention is that since COVID, with inflation going up, interest rates going up, the end of QE, actually you're returning to something that is a bit more normal relative to long-term standards. And if you need evidence of why that might be the case, what we're showing you here is that financials have started to outperform the market, and not just recently. This has been going for 1, 3, and the best part of 5 years. So the yellow bar is the performance of just the financials index, and then the dark blue bar is global equities. So it's done better over each of those 3 time periods. And then we've also showed you value, because we want to convince you that there's a change in the market regime. Financials are doing better than global equities, but we also want to tell you that financials are better than value on average as well, because there's a lot of really exciting stuff going on in this diverse range of subsectors that we talked about. So the proof is in the pudding. It's already starting to work, but valuations are still very attractive. So what we'll do now is run through a couple of sort of main themes that we think are really interesting within our portfolio that you might like to hear about. So we'll go through them in more detail later on, but just to highlight them. So alternative asset managers, we've got some strong structural tailwinds, insurance, it's a very hard market. We've got data providers. There's an extremely large amount of growth in demand for data provision within financial services. We have a part of our portfolio that we call turnaround, which are sort of very strong risk reward profile stocks. And then US banks, which is an area that we've added a lot to very recently in the run up to and subsequent to the election. And then here you've got a sense of how much of our portfolio is invested in each of these sort of areas. So let's go through them each in turn. Alternative asset managers have been a really exciting part. So just to put that into context, that's way to get access to private market investing, whether it's private equity or private credit. There's huge demand for the asset class. The structure of the way that the companies make money is really attractive. Your money tends to be locked up. They generate attractive fees, and the end client has had fantastic returns over long periods of time, which is why the demand for this as an alternative to listed markets has been growing. So a theme that we like and we think is here to stay. What this chart is showing you is pricing within the global catastrophe reinsurance market. So remember, I was saying that it's basically a bull market if you're selling commercial insurance or reinsurance, and it has been recently. And that's what this yellow line is indicating. So it's giving you a sense that for a very long, this is the best operating environment for a very long period of time. And here are some companies that we invest in that have exposure to that benefit from this kind of backdrop. It's at a cyclical peak, but here we shift from this is the period where people underestimate the earnings upside to the companies, and now we're in the period where they continue to deliver good returns and people will underestimate the degree of capital that they will return to shareholders. So another part of the sector that we really like. Data providers. So everyone wants more data in most industries, and this is just giving you a sense of the tremendous growth in demand for data services within financial services. And a lot of the stock exchanges do a lot more than what they used to do, charge a commission on transactions happening. They're now much more comprehensive providers of data to their various customers, and that's a much more recurring and impressive type of revenue stream. So it's another sort of long-term theme that we think is really interesting. And here are some of the companies that we have exposure to. Turnaround. This is quite interesting because these are quite. It's less a theme. It's more something that we think where we can add value because we understand the companies. So the stocks that we hold in this part of our portfolio, they're completely idiosyncratic. So it's not really about what industry they operate in. It's about a really significant mispricing opportunity that we're trying to take advantage of as a result of what we understand about the various different companies. So I won't go through all of them necessarily, but Allstate is a car insurance company in America. It's one of the biggest ones. It's spent 8 or 9 years declining because it's underinvested technology. Our assessment is that it's improved that now. It has a much better distribution capability, and we think it's going to inflect in terms of growth, and that will have a dramatically positive impact on the valuation. Barclays, everyone will have heard of. That's a business that, UK banks were a pretty challenging place to invest for a long period of time. Under new management, they've reinvigorated the business. They're going to fix and grow the investment bank, and they're investing more in their UK operations. Another one where we think, trading at a discount to book value per share, that's actually a really interesting opportunity. And there are a number of other ones here. So you get a sense of like what we're trying to achieve here is understand the companies really well, make the investment case really about a large margin of safety, and capture that sort of idiosyncratic alpha. US banks, so this takes a bit of explaining. So what we try to do here is rate what we think the impact is on US financials from the Trump administration. So we've got various subsectors on the left-hand side. Then each of the columns represent our sort of qualitative scoring on how positive the various different categories are. So deregulation, for example, we think is really positive for US regional banks. It will likely lead to more M&A transactions. There's actually been already an M&A transaction amongst some very small banks since Trump was nominated president. So that's deregulation, which is an important theme. Higher rates, that's the sort of reciprocal of a lot of the inflationary policies that he has. It means long-term interest rates stay high. At the same time, the Federal Reserve is cutting interest rates. So that steepening of the yield curve is actually very beneficial to a lot of these businesses. Capital markets is really about the fact that some bits of the market, like IPOs, have been a little bit slower than they have been historically. And we think M&A and capital market activity is going to be really bullish, particularly if you have an investment banking business like some of the companies like JP Morgan have. And tariffs is generally negative for everybody. But the point of the slide is when we take a sort of a judgmental approach to assessing what we think the upside is to each of these sectors, so the top winners in this environment are regional banks, large banks, and then we give you a sense of how much of our portfolio we have invested in these and how overweight we are, almost 10% in this area. So it's something that we feel quite strongly about as an opportunity, and we're trying to take advantage of it for our clients. So those were the main themes. So let's talk about sort of financials related valuation. So what this is doing here is the orange diamonds represent the current forward P multiple, price to earnings multiple of these various global sectors. And then the blue square represents the median over the last 20 years. So what you see is value-oriented sectors, obviously, are towards the right-hand side of the chart. Financials is right here. Now, you'll notice that financials are actually towards the upper end of long-term valuations, but still hugely discounted relative to other sectors. And right at the other end, you'll see IT at very, very high multiples. Same for growth-oriented sectors. So the point that we're trying to make here is that we're saying the investment landscape has changed. We try to give you evidence of why that's happening. Financials have been outperforming, but actually the valuation opportunity is still very compelling. And this slide here is all about showing you that there was a time when value sectors were a much bigger part of global equities. So what you've got here is these are more value-oriented sectors in the light blue. They're a quarter of global equities. So that's financials, energy, materials. And as things stand, more growth-oriented sectors like technology and healthcare are just shy of half the market. What's so fantastic about this is how symmetrical these changes are. And to remember a time before the GFC in 2009, when that positioning was completely reversed. So this isn't something that what we're pitching for in terms of financials doing well isn't something that hasn't happened before. It happened just before the GFC. I think this is a really fantastic way to say that whatever you think about how good some of these companies are, there has been a time when actually this sector has done a lot better. So to try and sort of wrap it up, our view is the investment landscape has changed since COVID. And we think that that means it's a good time to think about financial sectors. They have the potential to help you diversify your portfolios away from what we imagine is underappreciated concentration to a certain number of small themes, and certainly benefit from a rotation towards value. And we're really pleased with the long-term returns that the trust has delivered, which we hope to continue doing in the future. So that's pretty much us in a nutshell. Happy to take any questions that you might have.
Fantastic. I got no questions online at the moment, so I'm going to open it up to the floor. Lady there.
I noticed that this trust has been doing well all year, and I was wondering, which companies in particular are contributing to this. Like, for example, in a sort of technology trust, people often say it's Nvidia. And so, what are your star performers here?
Yeah, it's a good question. It's actually a variety of different things. So some of the best performers that we've had have been trading businesses. So IBKR in the US, ways or IG Group in the UK, ways for retail investors to participate in markets. The reinsurance stocks that are in a hard market that we talked about, they've done really well for us. Actually, some of our UK banks holdings, we own Barclays and NatWest. They've been really fantastic contributors. So it's actually a lot more diversified. It really is not driven by one or two stocks. It tends to be pretty broadly based across the sectors. But those would be the standout ones, I'd say.
Other questions? To what extent do you churn the portfolio? Because you put up various charts, and one had JP Morgan in it, which was just a nice 45-degree line
Yeah.
over many years.
Yeah.
And you'd hope you'd held that the whole way through.
Yeah.
But then, you seem to have data and stock exchanges amber at the moment.
Yeah.
And yet you've also said that they're big growth areas. So
Yeah.
I'm just wondering how much you are switching the portfolio around.
The average holding period tends to be 2 to 3 years, something like that. Some stocks like JP Morgan have been in the portfolio, so far as I'm aware, for most of the time. So I think it really varies. There's some, I mean, it's kind of the point of this, the point that we're trying to make in, well, I'm going down is up rather than the other way, right? This one here. So there are some stocks like MasterCard has been in this one for a very, very long period of time, because I think over time it just keeps compounding, and not everything in the portfolio has those compounding characteristics. Otherwise, we really wouldn't be a financial services fund. So there's a lot of other stuff like the trading companies that we talked about in answer to the previous question. You have to be a lot more nimble in those. So I'd say on average it's 2 to 3 years, with some things that we think have more attractive fundamental characteristics being in there for a very long time, and other things potentially being much more short-term catalysts. I mean, on one of the slides, we were talking about stocks that were turnaround opportunities. I mean, that's in many cases, that's not about saying we think the business is great. We just think it's far below fair value. And when it gets there, we'll sell it. If it does that quickly, we might only own it for 6 months. So the answer is it depends on what the specific opportunity set is.
Thank you. This is very excellent presentation, if I may say so.
Thank you.
I've got two questions. One is about diversification. I can see that different sort of economic activities, but is there any geographical diversification taking into the Far East and all this? And
Yeah.
second thing is, as you know, these days, people are using in everything AI, artificial intelligence.
Yeah.
And one of them got a Nobel Prize using it in protein folding. Do you use any artificial intelligence, developments in when you search and research or anything
Yeah.
like that?
Yeah, okay. So to your first question about geographical diversification, as things stand, we've got about 60% of the portfolio in the US. That's a lot higher than it was a few months ago. That's largely driven by the opportunity that we see as a result of the US election. Then we've got a decent allocation towards Europe and emerging markets. So it is geographically diversified, but I'd say as things stand, we're quite weighted towards the US because that's where the greatest opportunity is as things stand. But we've got some interesting, I mean, we own Korean banks, Japanese banks, insurance broker in Australia, Latin American e-commerce business. So there's a variety of different things, but the weight of money as it stands is in the US. To your question about AI, yeah. So on AI, it can be a helpful supplement in the research process. For example, we use a service called AlphaSense, which goes through conference call transcripts and tries to highlight sort of things that companies say that are positive or negative, which can be a way to accelerate the speed with which you can sort of process or digest what's been going on. Those sorts of things are I mean, we don't integrate ChatGPT or anything like that. It hasn't really worked. I mean, what I think in terms of our sector, what we think is really interesting, and that's not something that we use, but an opportunity set. So everyone has a slide that says, here's why AI is great for our sector. So I'll tell you mine, and then you can decide whether you believe it or not. So there's some fantastic data by Accenture where they look through all global industries and they rank them based on what proportion of their workforce can be optimized through artificial intelligence and machine learning. So it's really about which industries have the greatest scope for operational efficiency improvement. And banking and insurance is right at the top of that list. So if you've ever dealt with an insurance company or a bank, you'll probably appreciate that it never feels like a very slick operation. Some of the newer ones do, but our pitch for what the opportunity set is with AI is that if the companies can take advantage of that, then there's an expense saving synergy rather than a huge transformational growth. But like the thing that people often forget is you think that the best way to play AI is through a new startup, but you look at companies like JP Morgan, they spend 15 or 16 billion dollars a year on IT. So some of the largest incumbents actually can be disruptors. And in the case of JP Morgan, they have Chase in the UK, a mobile only based app. So that in some examples, they can be at the forefront of disruption and digitalization. So there are opportunities. Our pitch is it's about efficiency saving rather than growth, for what it's worth.
And do you have your own research and development section, however small it is, who
Oh,
actively
it's
do that?
basically the five of us. That's the
Yeah.
that's the team. So what we do is we split the world up between different geographies and sectors based on our respective levels of experience in those areas. But we effectively take the decisions for the trust together. And the thinking there is that you end up with better decision making on average if you peer review each other's ideas, because people fall in love or out of love with certain stocks, and it's better to have someone else tap you on the shoulder, say, is that really a good opportunity? Or actually, you don't like this, but now it's going to come good. So that's broadly how we operate.
And finally, if I may ask you,
Yeah.
how many people probably you have got in this research development section?
Oh, it's just the five of us at the beginning. So I'll show you a picture. If I can find it. That's it. That's the, yeah. Yeah, of course.
Isn't the problem with the financial sector that it is for the, most shareholders, probably the least understood sector if you compare it with either healthcare or IT? And I mean, how do you actually convince or how did you manage to draw, your current investor, especially within the context of an investment trust? I mean, I find it extremely difficult to kind of, from the diversity that you have shown through the charts, through the various bits and pieces of the jigsaw, as it were, completely very difficult to penetrate.
Well, I mean, that's our job, right? I mean, all we do every day is look at financial services companies. So our job is to try to understand the various moving parts and to allocate our clients' capital into where we think there's the best risk reward at any given point in time. 2 or 3 years ago, if we would have been talking about the trust, it would have just all been about banks. And, at that point, we would have had a lot more invested in banks. But it's a much more diverse sector than that. So it doesn't, I mean, we could tell you it's all just about one theme, but it wouldn't be representative of what's really going on. And the complexity, I think, is the opportunity, which is one of the reasons why the sector trades at such a discount, despite actually having delivered very attractive. So despite having outperformed the global market, it's still cheap because earnings upgrades have been really, really strong generally across the board. So yeah, our job is to try to find those opportunities for you.
But if the shareholder is not actually getting to grips with it, I mean, they have to trust you completely and utterly, and they are in your hands, and you don't know what is going to happen. I mean, it's not something I would jump in because I lack the experience and the understanding. That's what I'm trying to highlight.
I think I have to say from the general side is that the trust has returned 10% per annum since launch, where the sector has largely been out of favour. We probably haven't seen the environment we may well see now since the 80s or 90s. So a lot of people haven't seen a different environment for financials. And our job is, Tom says, to educate and highlight this is a very large space that actually now, for very specific reasons, in addition to the valuation, etc., people should consider.
And it's a specialist sector, so if you are going to consider it for the reasons you said, that's why you need Tom
Two questions. One of them, first one is, do you build complex models or it's more an art than a science? That's the first question when you're building up positions. Second questions, when do you sell?
What was the second one, sorry?
Second one, when do you sell a position?
When do you sell a position? Okay, yeah. So in terms of modeling, it depends. The degree to which modeling adds value varies. So we've got standard models for, we actually have a screening tool that we developed ourselves, particularly for bits of the sector like banks and some bits of diversified financials where where the operating metrics are very consistent globally. So you can use that. We effectively use that to rank all of the banks in a given region based on growth, valuation, and risk. So that's our own sort of proprietary tool that we use. There are other bits of financials like insurance where that works less well because the accounting is very different in the US to what it is in Japan or in the UK. So the answer is where it actually adds value, we develop it in-house ourselves. And then sell discipline, I think it goes back to the conversation we were having earlier. There's certain stocks where if the underlying business is delivering high levels of return, we tend to run our winners. In the case of the more shorter term turnaround type opportunities, the sale really is like share price driven. There are always things that don't work. We have a sort of discipline of saying if something underperforms by 20% over a 3-month period relative to the benchmark, that we'll revisit that. And the reason for doing that is really just to make sure, have we missed something in our assessment of this opportunity? But yeah, so the answer to the sell discipline depends on the type of investment that it is.
Do you hold any direct line?
We did. We did, and it didn't work.
Well, it works today.
Sorry?
There is a beat today.
Right. Okay. I mean, it is an intensely competitive industry. They had a bid not that long ago.
Yeah.
We were actually owning it because we thought that the current management team, which is reasonably impressive, could turn around that business. I mean, we've followed Direct Line. I wrote a report of it in 2012 when it IPO'd. So I've known that business for a long time. What's happened, and the reason that we sold it, is that the UK motor market is one of the more cyclical parts of the sector, and pricing has just come under pressure. And what that means is that all the cost-cutting efforts that the company's doing are, so I haven't seen the bid, but good luck to them. I mean, there are very, very many insurance companies that I've spoken to and asked, would you consider Direct Line, particularly ones from outside the UK, and the answer is pretty categorical. So good luck to Aviva. We don't own Aviva either.
Hi, Tom. Yeah, can you tell us a little bit about your management fee and dividend policy, and how does it compare to similar kind of companies?
Can I bat that one to you, Rich?
Hello. If I heard the question correctly, you're asking about the dividend policy. The management fee is 0.7% of NAV, and I think the total expense ratio is 0.81. So it's pretty competitive, I would say, and that's the all-in costs. Was there another question, sir? Dividend. We're yielding about 2.75%. We've always maintained the dividend. The aim is to grow it during COVID. As you can imagine, for financials was not easy, but we had reserves in the trust, which we utilised because we know people like the dividend, and now it's starting to grow again.
How concentrated? How concentrated is the portfolio? I mean, are you taking big positions as a percentage? And what's the role of the benchmark, which is a sort of
related question? Yeah. So there are about 60 equity holdings within the trust. 60, yeah. So it's reasonably concentrated, but not extremely so. the largest positions relative to the benchmark might be, you might be 3 or 4%, have a 3 or 4% greater position than the benchmark. That's the sort of tends to be the largest sort of level of overweight. We're measured a bit against the benchmark, so it does factor into our thinking, but we tend to try to prefer to think more in an unconstrained way, as in which bits of this diverse opportunity set do we believe have sort of an attractive return potential for the next 2 to 3 years. If we get that right, irrespective of its position in the benchmark, it'll generally do really well for us. And MasterCard is a good idea of that, a good example of that. That was not in the benchmark for a while, was owned in the trust. Then it came into the benchmark last year or 2 years ago. So yeah, it's we have to bear it in mind because that's what we're measured against, but we like to think more in an unconstrained way.
Thank you. Following on from MasterCard, on the payments companies, you seem to be invested in incumbents rather than challengers. Is there a reason for that?
Yeah, because they deliver better returns over the long term. And we'd rather settle for 10% steady than 30% 1 year and then minus 15 the next. So not to me too flippant, but that's the thinking. Yeah, that's true. Thanks, Reg. A helpful hint. Yeah, no, so the trust can, so additional features that the trust has is the ability to use gearing. So we've actually increased the use of gearing in the last couple of months because we felt that the market had a lot of momentum into the US election. So we can use that as a tool to dial up or down the amount of risk that the portfolio in aggregate takes. As things stand, yeah, the gearing is as high as it's been for a little while.
Thank you. I'm not standing behind you to put you off. I'm checking for online questions,
Sure.
which I'm not seeing.
Okay.
One more from me, if I may. You're reasonably aggressive by the looks of it on alternatives, which puts you in private equity space. Private equity has been gorging itself on financials, this financial sector for a while, and valuations that it's paying and the harvesting that it's doing on those valuations are starting to raise some questions. What's your thought on that?
That sounds like a loaded question.
Yes.
Yeah, I mean, so we like the alternative asset managers for the reasons we sort of discussed. The client demand to allocate is growing. The business models are very attractive, but to your point, I think you've got to be very, very careful. I mean, one thing, for example, is we tend to own the very largest companies because, like in a lot of industries, like with the payment networks we were just discussing, the incumbent players tend to do better. They're still able to raise funds. So it's definitely true that their ability to exit investments has been a little bit more tepid in the last 12, 18 months. But actually, enthusiasm around the Trump administration sort of loosening the wheels a little bit is one of the reasons why they've done fantastically well. If you look at how the share prices of some of our holdings have done in the last 3 or 4 months, it's pretty aggressive. If anything, actually, we've been trying to take a little bit of profit, conscious of the fact that some of them trading on 30, 35 times earnings. So I think the answer is bigger is better. The other thing is that we tend to own companies in a better position in the capital structure, so private credit rather than private equity, as in, you know, a preferential position. So that would be my response. It still feels like an area where, you know, subject to the recent sort of enthusiasm, in the long term, it seems to have still good dynamics, much as public investors don't like it so much.
Thank you. And final question, the ubiquitous one, premium discount?
Discount 7% at the moment.
And the history of that discount?
Reg, you'll correct me. Gone from
10 or 11, trust has a 5-year tender, which the next one is due in June. It previously been done 100% at -1.
Okay, so 7% currently, down as low as -10, and
so 3 or 4 premium at times where it's been in favour in the 21, 22 period.
Super.
And then I was just saying, Martin, I mean, this is the end of the audience, the eagle eye noting that we're negative on traditional asset managers, but not asking Tom You won't have that.
Fine. I see nothing else online. So, Tom, thank you very much indeed. Very interesting indeed.
Thank you.